Welcome to our session on financial accounting. For basic accountants, it is actually called bookkeeping. The first part of accounting is called bookkeeping. So you need to be very familiar with the concepts in accounting. So by the time we're done with this, you need to be able to differentiate accounting from bookkeeping, understand the types of businesses, the fundamental elements of accounting, and how to use the accounting equation. And also we'll go to the ledger account and how to balance a trial balance. So to start with, we can define bookkeeping simply as a systematic method of maintaining accurate and complete records of daily financial transactions of a business. So it is a first step that we always have when we indulge in an accounting process. So bookkeeping uses basic accounting processes. Accounting, by definition, is simply the processing, analyzing, classifying, recording, summarizing, communicating, and interpretation of business transactions that are expressed in monetary form. What is a business transaction? It is simply an event that occurred in monetary terms. This event should be capable of being recorded in the books of accounts. Examples of transactions may include buying goods, paying wages, paying rent, selling goods, or purchasing an asset. So we have different types of business organizations which stream from sole traders, partnership companies, and cooperatives. A sole trader is a one-man business. The person in charge is in charge of the daily transactions. He makes the managerial decisions, and all the proceeds are his in terms of profits, as well all the losses are his in terms of a business loss. So a sole trader, an example is a shoe repairer, a workshop, a trade store. When we're dealing with partnerships, basically we're dealing with two or more persons who venture into a business under a partnership deed, and they're called partners. This type of business brings together a pool of skills and resources with a view of making a profit. Each partnership can either be oral or written, and the partners in this turn will contribute resources in terms of capital, and in the partnership deed, it will stipulate how much profits will be shared out and the responsibilities of each partner, and also it will stipulate how the partnership can be dissolved and how the partnership can be amended. So the disadvantages of each of these between a sole trader and a partnership is that both have unlimited liability, meaning the death of a partner or an individual will really cause the death of the business itself. The other disadvantage is that they both have unlimited liability, meaning the deaths of the individuals and the company, in this context, the business, are the same. Advantages of a sole trader is that he enjoys all the profits and decision-making. Its advantages is that he dies the business and the decisions are not as prompt and clear as that in a partnership, because partnership has a pool of resource and skill. And moreover, the quality of decisions is more refined because there's a pool of skill in the partnership. Later, we have a company that is created by the law in Zambia, Cap 388, which brings into corporation a company. This company has a personal attribute, can sue and be sued, and basically can make contracts and contract. So partnership and unlimited and sole trader both have unlimited liability, but for this kind of business entity, it has what we call limited liability. So the owners of the business, who are called shareholders, are different from the business itself. These shareholders contribute capital to establish a company and receive an earning called a dividend. They are separate from the business. They appoint a board of directors who run the affairs on their behalf. And these are the people who do the day-to-day running of a business. We also have a cooperative, which is a form of business which is owned by the customers, who are the owners themselves, to provide a service at a low cost rather than buying from other people. And when the profit is made, it is distributed among the members so that each of the member in the cooperative can benefit. So these are the forms of businesses that you need to know. Let's do a quick, can you remember? True or false? Bookkeeping is a subset of accounting. Is that true? Yes, it's true. A sole trader is owned by one person. True or false?
True.
True. Cooperative is a form of business whose sole purpose is to make a profit. True or false?
I didn't get the question.
Number 3. A cooperative is a business whose sole purpose is to make a profit. True or false? False. It is meant to improve the livelihood, not to make profit, to reduce the cost of doing business. A business should be a separate entity from its owner. True or false?
It's true.
True.
It's true.
True. So we go to the elements of a business. There are 3 fundamental elements. We have what are called assets, liabilities, and owner's equity. When you're dealing with assets, our vocabulary now must change. So assets come in terms of fixed, come in terms of current, and intangible assets. So these are simply the belongings of a business. So assets are simply the things that the business owns to generate cash. So when you're dealing with current assets, we're basically looking at items that are easily converted into cash within a short period of time. These include cash, debtors, inventory, and prepayments. Fixed assets, on the other hand, which we call non-current assets, are simply assets that are used in the normal operations of a business. They are used to sell or perform services for its clients. These are used in a business such as buildings, fittings and fixtures, vehicles, and land. Intangible assets, on the other hand, are simply the assets that the business benefits from for many years, which have no physical substance. They are not tangible. Examples include goodwill, patents, and a trade name. So liabilities, on the other hand, are simply the debts that a business has to its creditors. So if a business borrows money, it becomes a debtor. The person who the business owes is a creditor. So if the person fails to pay its debts, they are due, the creditor can claim the assets of the business as a whole. So we also have what we call owner's equity. This is simply the money that the business starts with. We know that the business usually may not have its own money. So when the owner puts his or her own money in the business, we call that owner's equity. Also, the owner may borrow money in terms of liabilities. And so this gives us an accounting equation, which we must all be familiar with, that assets should be equivalent to capital plus the liabilities. This is our accounting equation. So we must all be familiar with this accounting equation. So, quick, can you remember? You need to tell us whether this is an asset, a liability, or equity. Cash in the bank, what kind of element is that?
It's current asset.
Current asset. Money from the business owner,
It's equity.
equity. Furniture in the business,
They are tangible current assets.
a fixed asset. So used for
The fixed
money owed to creditors,
Liability.
business loan from the bank, Current liability, business trade name. It's an intangible asset. All right. So we talk about the accounting equation that we must understand that assets is equal to liabilities plus capital. So we now need to go down to understanding how we can classify these ones. So we say classification of the balance sheet is simply the fulfillment of the accounting equation that assets should be equal to capital plus liabilities. So assets, we have current assets, we have fixed assets, and we have what we call intangible assets. Liabilities, we have current liabilities and non-current liabilities, which we also call long-term liabilities. We also have equity and retained profits. So these must balance. So write down the meaning of each of these ones. What are current assets? What are fixed assets? And what are intangible assets? Give examples where possible. What are current assets? These are what the business owns and can easily be converted into cash within a period of a year. Fixed assets, these are meant for use in a business, such as land, equipment, and intangible assets. These are what the business has accrued over the years and are not tangible, like goodwill and a trade name. So investments include what the business has invested in, like stocks and bonds, for more than a year. Current assets are claims against assets of a business during a period of a year. Long-term liabilities are simply claims that are not due within 12 months. And owner's equity simply the amount that the owner has put. So these are basic things that you need to know in the first unit. Second unit, we're going to look at the principles and concepts. So the accounting principles we need to know have 11 principles that we need to know. There's what we call the entity assumption, going concern, the periodicity assumption, monetary assumption, historical principle, objectivity, revenue realization, matching, consistency, disclosure, and prudence. These are important in our preamble. So to start with, the entity principle simply asserts that a business should be separate from its owners, meaning personal affairs must not mingle with the business affairs. We also have the going concern, which simply assumes that the business has a foreseeable future, it must run forever. As a going concern, for instance, the person who started the company, Brian Bell, started it in 1961, but still goes on even after his death in 2010. The company has a going concern. Periodicity concept simply assumes that the business must report all its transactions within a standard period of, say, a day, a week, a month, a year, or even half a year. So this is very important so that we may cover the period using the reporting of the accounting year. So companies differ. Others, the accounting year ends in March, others in December. This is important. Monetary unit concept simply assumes that all transactions in a business must have a currency. For instance, we may use a kwacha, a pula, etc. We don't use cows. The historical cost concept simply assumes that we must value all assets and liabilities at the acquisition price. And so if we bought a building at 50 kwacha in 1990 and now we are in 2023, we must record it at the original price, even if it has accumulated a value. Can you remember? Please attach the number to the definition. For instance, we have the principles that are 5 here. So a company's balance sheet should report its land at the price they paid to acquire it. What principle is this? From this, what principle is this? 5, which is historical cost. Then a company account should cover a specific period of time. What principle is it?
3.
3. Correct.
Periodic.
Personal assets of the owner should not appear in the balance sheet, but principal. One, entity principal. A business will remain in operation for a foreseeable future. What principle is this?
2.
2, going consent. Then transaction should be recorded in unit currency. What principle is that? 4, monetary unit principle. Okay, so we also have the remaining. We have the objectivity principle, which simply assumes that the financial and accounting information of a company should be independent and based on evidence and verifiable data. This helps us make informed decisions. The matching concept or the revenue realization principle simply assumes that the price paid for the goods and services is called revenue. This means that revenue is realized upon goods being sold, not when the cash is received. So if you supply goods worth 10,000 or 1,000 today, you record it as a revenue as soon as delivery is made, not when you receive payment after 30 days. Matching concept, which is called the accruals concept, simply assumes that costs must match with revenue earned in the same period. Consistency period simply assumes that you need to adopt an accounting practice or method that should be consistent throughout the accounting period. This makes it easy for you to report and understand. The disclosure principle assumes that you must present all relevant facts that are needed in a financial statement, accompanying notes to the reader to understand so they could make an informed decision. And prudence concept means that there should be carefulness or caution when making a good judgment. Therefore, when reporting and there are two acceptable alternatives, you should get the worst case scenario. For instance, where you must not overestimate your assets nor underestimate your liabilities. So you get the worst case scenario. So this is basically about unit 2. So a quick, can you remember our entity assumption? The owner and the business are separate. Going concern, business has a foreseeable future. Periodicity concept, report financial reports within a designated period. Monetary concept, transactions must be in currency. Historical principle, record assets at their original cost. Objectivity principle, means statements should be verifiable. Revenue realization means record as soon as revenues end. Matching principle, expenses should be recorded in the period which they incurred. Consistency, you must adopt one accounting method throughout the year. Disclosure principle, provide all necessary information to help understand financial statements. Prudence principle, do not overstate your assets or understate your expenses. So this is what our unit 2 was all about. Are we following? Let's go to unit 3. So it becomes denser as we go down there. So in this unit, basically, we want to understand how to journalize and how to post to the ledger and how to look at the double entry bookkeeping principle. So here we must understand that there are basic books of accounts that we know. There are books of prime entry and there are books of secondary entry. The books of prime entry are books where we first record the transactions. For instance, the cash book, where all cash transactions are recorded, and the document for cash book are called receipts. The checks, where we all record our bank transactions. This is also done in a double or 2-column cash book. We also have payment vouchers and journals. So these ones provide a detailed transaction of the name of the client, the nature of the transaction, the date, and the contacts where possible. We also have books of secondary entry, which are used after the original entries are done. They summarize, they group the transactions, they itemize them, and also helpful for preparation of the final accounts. The best example is called a ledger. A ledger is simply a book of accounts. So we're going to look at the journals, ledgers, cash books. So what is a journal? A journal is a book of prime entry where all credit transactions are recorded. We have different types of journals, where what is called the general journal. This is simply a book where transactions that cannot be recorded in other journals are recorded. It is a general book. We also have a cash receipts journal. This is simply where all cash transactions are recorded. We have a purchases journal where all credit purchases are recorded. Sales journal, all credit sales are recorded. Purchases returns journal, all returns or allowances on goods are previously sold on credit. We also have sales returns journal. So, like I said, a ledger is a book or a home of accounts. So we're going to look at the T account. And an account is simply a detailed financial record which stores information associated with assets, liabilities, equity, revenue, and what? Expenses. So we're going to learn of a term called PERLS. P-E-A-R-L-S. PERLS. So debit and credit side. We always debit our purchases, our expenses, our assets. We always credit our revenues like capital, our liabilities, and our sales. So we're going to look at what is called a T account. A T account simply looks like letter T of the alphabet. And as we can see here, we have the debit side, which we denote by DR, and the credit side, which denote by CR. So now we want to learn how to make entries in this T account. So why are all accounts divided into the debit side and the credit side? This is due to what we call the duality concept of bookkeeping, which simply states that for every debit entry, there should be a corresponding credit entry. So the D account have 4 basic rules. Number 1, the left side increases assets. Remember, I said we have pairs. So the left side increases all assets, the right side decreases all assets. So if you want to increase assets, we debit. If you want to reduce it, we credit. So the left side also decreases equity. So this is our revenue equity. So if you want to increase equity, we credit it. If you want to decrease it, we debit it. So this is our G account. So we need to understand how the treatments are done. At this point, are we together before I proceed? Are we together?
Yes.
Proceed?
Yeah.
Okay, so I cruised a bit because I didn't want to dominate on what you already know. I just wanted to first start with the basics of what you already know. Okay. So quick, can you remember? Number 1, kindly tell me the items that are found on the debit side to increase them, and the items that are found on the credit side. Okay.
Repeat the question.
Kindly itemize the items that we increase on the debit side, and the items that we increase on the debit side, on the credit side.
Debit assets.
So to increase on the debit side, assets we debit them. To reduce them, we credit. Expenses, increase them with debit. To reduce with credit. Capital, to increase with credit. To reduce with debit. Liabilities, with credit. To reduce with debit. So this is the procedure that I was explaining earlier on. Now, having to understand this, we must understand that the procedure, firstly, would be to identify the elements that are affected. Then we check our T account, and for each identified element, we should see whether it exists or not. then we create it. Then we are going to now assume the double entry rules. So we're going to look at a few questions here where we're going to start up with the T accounts. So we have an example, number 1. Mrs. L. Moyo started a business called Moyo Limited and deposited 5,500. So which items are we able to identify in this transaction? We have the capital account. Whenever we start a business, it's a capital account. All right, we have bank account there. All right. What else do we have? Okay. July number 2. Can somebody identify the 2 elements that are here? Purchase goods for resale on credit for 540 from Trade Kings. What 2 elements are we able to identify? Pardon? So
There's purchase and Trade Kings.
purchases, yes, and what? Trade Kings, correct. So we know that purchases always debit. Who is Trade Kings to us?
The credit.
Correct, creditor. Then number 5, what 2 transactions are we able to see? Recorded sales on credit for 450 to Chongwe Council. The sales
And Chongwe Council.
Chongwe, correct. Sales, and who's Chongwe? Our data. So all debtors have a debit balance. Creditors have a credit balance. So paid rent on office premises by check. Can we identify 2 elements? We have rent, which is an expense, and we have bank. So rent account is going to be debited. Why? To increase our expense account, we debit. Then the bank account is paying out, it's reducing. So to reduce the asset account, we're going to credit it. How about July 11? What 2 transactions, 2 elements can you see? Withdrew cash from bank or used in the cash till?
Drawings and bank.
Drawings and bank. If it's for personal use, that's when it becomes drawings. But here we only have bank and cash account. All right. So we just withdrew cash, the contra entry. So the bank account is reducing in figure and the cash account is increasing. How about July 14? Recorded sales for cash, 180. Which 2 transactions are we looking at?
Sales and cash.
Ooh, the sales and cash. So cash is an asset. To increase it, we debit it. Sales to increase always have debit balance. Okay, paid insurance in cash for 5 quarter. Which 2 transactions are we looking at?
Insurance and cash.
Good. Insurance and cash. So insurance is an expense. We're going to debit it. Cash is reducing. We're going to credit it. Retain goods valued at 180 to Chongwe Council. So what 2 transactions are we looking at?
Returns outward.
So sales returns and Chongwe. So Chongwe was our data. So to reduce the data, to increase data, we debit, but to reduce them, we credit them. Sales returns, we're going to debit it. So this is sales returns or returns where? Return inwards. Bought delivery van on credit from Toyota Zambia. Which 2 transactions are we looking at? Delivery van and what? Toyota Zambia. Delivery van is our fixed assets. And our Toyota Zambia is our what? Creditor. and paid sundry expenses for cash, 67 kwacha. Which two transactions are we looking at? The expenses and the cash account. Are we together? So this is how the transactions now flow. The first transaction we had was a capital account. So we needed to identify the affected elements and also check whether the T account can be identified. If not, we can make or create for it and then make the correct entries. So here we have the capital account and we have the bank account. So whenever we're starting capital always increase because it's a revenue. Remember, when you're using pairs, always have this in mind. So capital, to increase it, we do our credit it. Then bank is what? An asset, so to increase it, we debit it. So that should be corresponding transaction like that one. Purchase goods from Trade Kings, 540. So we have purchases and Trade Kings. So we start with the purchases account to increase it under pairs. We debited Trade Kings, credit because it's a creditor. Then recorded sales on credit from Chongwe at 450. So we have sales under pairs, which is on the credit side. The sales here are here to increase them. We the credit. So sales, credit, and Chongwe is the data. So we're going to debit. Are we following?
Yes, we are.
All right, so I understand they're basic users of accounting. So I've done videos also on other topics. So in case you're slightly behind, I need us to move with the pace of your lecturer because most of the questions are coming from Frankwood. So I assume your test will come from here. This is a question you're looking at. So for you to understand what I'm talking about, you need to understand the basic concepts. So this is what you're looking at in class. But also I need you to understand basic concepts first. Paid rent on office premises, 450. So we go to bank and rent. Bank already had capital, the same account we go. We paid rent 450, so meaning it's giving out, so we're reducing our asset account, but the rent account is an expense. To increase it, we debit it. So these are the transactions. Goodness with accounts, every entry has what? A mark. Withdrew cash from bank, 800. So the cash is receiving, the bank is giving out. So where there's bank, we're going to credit it. The cash too is receiving 800. This is called a contra entry happening within the business. So recorded sales of 180 for cash. So we got the sales in the cash account. So cash is receiving 180, the sales account, we are debiting. So paid insurance for 145 by cash. So cash is giving out and insurance, we're receiving the service. So insurance 45, cash 45. Then goods had been sold to Chongwe. Council for 180 that we retained. So council had retained us. So we're looking at sales retained. So we're going to reduce our sales. And also we're going to open the sales retains account. So we go here, retains inwards, 180. This one at 450. So to reduce, we don't subtract in accounting, we just open an opposite transaction. So we call it the retains inward. So bought a van on credit from Toyota. So Toyota is a creditor. All creditors have a credit balance. Then the van is an asset. It will have a debit balance. So we go to van, debit. Toyota was a creditor, we credit to 5. Then we look at sundry expenses and the cash account. So expense account has a debit balance and cash have a credit since we are giving out. So cash 67, expenses 67. Then we can balance up all these figures and post to the trial balance. So the next session I'm going to have will be to teach you how to balance off the account, to extract it to a balance, and look at the period adjustments. From there, we'll go to coming up with a balance sheet and discussing the adjustments and going through the final account with depreciation. So this was our class for today. Unless there are any questions, we end here. Are there any questions?
Hello.
Yes, please.